Hey guys, Simon here. So I recently read a book called A Random Walk Down Wall Street, and it was recommended to me by an economist I know and also someone else. And it's something I hadn't read before, and they thought, oh, you should read it being a trader because what you do is just gambling, and you're on a bit of a lucky streak. And obviously I had to bite my teeth, and I didn't say anything. So I went away. I read that book in a day. Well, I listened to it, audiobook, and yeah, it turns out that, or this is my personal opinion, this whole book was written in the 70s, and it's a crock of shit, basically, and it's basically founded upon one main principle, which is the random walk, i.e. the EMH, so which is the efficient market hypothesis, which has been long proven to be a pretty bogus hypothesis. And basically it's saying that, well, here you can read it here, it's saying that no one can ever really beat the market because all information, all news, and any edge that you can have on a stock is instantly disseminated across the world by everyone, and so no one can ever have an edge. And the reason I think this is absolute bonkers is for two reasons. One, if this was true, there would be no successful traders, and there have been many decades of very successful traders and traders that have been beating the market time and time again for many decades. So it's highly implausible that you'd have, that these successful traders would be fluking it. Now, I've been trading for about 13 years now, but I've really only been successful for the last 5 years. And I wouldn't say friend, acquaintance, said I was basically having a good run in the markets. And I think it's absolute poppycock because these people that talk about the efficient market hypothesis, one, they're not traders, and two, they have no idea how traders really make their money, and it's all about risk management. I completely agree, no one is Mystic Meg, and I don't have a crystal ball, but it's all about taking the low risk, high probability outcome trades. And I don't know what's going up or down, no one really does, but you can use the charts to effectively or highlight probable outcomes, and then you basically place trades on that. And when you're right, you need to make sure that you only have, or in a trade you only need 3 outcomes: small wins, small losses, or huge wins. I say that over and over again to my students, and it's all about risk management. So that's one reason, and the second reason is that, or there's two others, is basically human psychology. So here's an old presentation I did ages ago, and basically I'm just going to quickly show you that this is the typical market punter, and this is the bell curve of emotions that most amateurs go through. That it goes from contempt to contempt, and it ends up in the sort of the euphoric stages of a market. Before all of the horrible things, the horrible emotions enter the fray, and then you end up wanting to burn stuff and punching your your laptop or your computer screen. And I mean, yeah, this is what the average public do. Obviously, traders who are sort of aware of this stuff, you have to be very aware of this stuff. So, I mean, boring trading is good trading. Now, one of the other reasons why I think that this is a whole load of poppycock is because, yes, you may not be able to predict the markets, but because no one can read the future, but you definitely can beat the market, because the market is moved by human emotions and human confidence. And humans, I mean, if you understand human nature in the markets, it's actually very predictable what happens. And number one of investing is always do the opposite what the public think and do. Always. And being a contrarian investor has always looked after me. And the reason I'm like that is because I know the public are like this. When something gets around here, every man and his dog goes, oh, bloody hell, I've missed out on the boat. Oh, no, it's not too late. And then they jump in. And most people end up getting in around here where the horns of greed pop up. And then they end up losing big time. And so when you start seeing an asset class, or an asset in particular, or a stock, or some sort of security enter this phase, you can make a low risk, high probability outcome trade where you're effectively trading sentiment. so to speak. So then, yeah, there's loads of times that happens. I mean, the stock market, the housing market at the moment, we're right here by sort of this horn at the moment. It's quite easy when you see like a bubble like Bitcoin, etc. So you can do that. And also another reason why the market, yes, I agree in the book that markets are completely random, and that, yes, that is the case, but they're not efficient. They are far from efficient. In fact, the market, there's a saying that the markets will remain irrational longer than you can remain solvent, and that I completely agree with that. But the markets are actually bonkers. So for instance, here is a ticker called Cuba. The ticker is called Cuba, but it's the Hertzfield Caribbean Basin, and basically it's a fund which invests in sort of Caribbean assets. However, it does not invest in any, don't know what happened there, it doesn't invest in any Cuban assets, real estate, nothing Cuban related whatsoever. But if we just go back a bit to sort of early 2015, there are several things that happened, and basically Obama in early 2015 started releasing tensions between the US and Cuba, and started announcing that Cuba will be, sort of taken off the terrorist watch list. And every single time Obama and whatnot made these speeches saying, Cuba, we're resuming relationships with Cuba, we had massive spikes in this Caribbean fund. In fact, nearly every time Obama opened his mouth about Cuba, as in the country, this stock just shot up. Now, this has nothing to do with anything Cuba. Yet the market has gone nuts, and it's because basically idiot investors thought, oh, Cuba, there must be Cuban investments, and they've just gone long, and they've bought. And then every time the markets realise that, oh, this is actually rubbish, it's fallen over. And since then, there have been articles since, and Cuba has just gone down. So yeah, again, another reason why I think EMH is a load of hocus pocus. Another reason why I think this is a load of rubbish is because you can actually use the charts to sort of help forecast the market. So here I have an online journal. So basically on our software, like all of our students, we have this online journal, and there's literally every student that wants to take part of it. In fact, those people need to change their names. And basically we can all see anyone's trade. So if I click on Kevin's, I can go into his trades, and I can see all of his trades along with the reasons why he got into them, etc., and the screenshots. And if we just exit this for a moment and go look at my trades, so here's one here's a trade in progress at the moment. So it's the US dollar versus Canadian dollar. I got in at that time at this price, etc. And I took a screenshot. So there's no hiding under stones, and I tend to doodle over my screenshot. So here I identified a rising wedge within a falling market, and we're seeing sort of compression here, and after compression you always see expansion. And so I basically went short, so I expected the market to go down from here, and also at that level there. And I said at any point around this area the market would punch down and do this. Well, this was the 5th of August when I took this screenshot, and now look, we're on the 18th of August. If we just get that chart open, oops, oh dear, having mouse trouble, sorry. Here we go. So if we have a look at US loonie, the Canadian dollar, this is exactly what I was effectively drawing. I'm going to do this roughly. So as you can see, as the market is being compressed, as I expected, the market punched down to at least this sort of 2750 level. And guess what's happened? The market has gone down and it's approaching that 2750 level, and I do expect the market to sort of hit this level and bounce off. So do I have a crystal ball? No, but I can take the low risk, high probability outcome trade, and according to the efficient market hypothesis, apparently this was just luck that the market fell in my favor. So yeah, this is just my synopsis of this, and I could talk for a whole week about this, but hope that helps. Toodaloo, cheerio, bye bye.